Hey everyone, welcome back to the channel. Today we're asking the big question, is the trucking industry still sustainable in 2025? Freight rates have dropped to a shocking $1.93 per mile round trip as a national average as of today. And for most carriers, that's dangerously close or even below their break-even point. So today we're breaking down what's going on, what's broken, and what's next for the trucking industry. Let's get into it. So let's talk numbers first. The average break-even point for a US-based trucking company in 2025 is roughly about $2.10 to $2.25 per mile, depending on the carrier's size, equipment, and debt load. Here's where the money goes. You have fuel at 65 to 80 cents per mile depending on your truck and the fuel consumption. You have driver's wages that can range anywhere between 60 to 75 cents per mile. You have the truck and trailer payment, which is about 25 cents to 40 cents per mile. Then you have your insurance that can range all over the place between 10 cents to 20 cents per mile. You have your maintenance and your tires, which can range from 15 cents per mile to 25 cents per mile, depending on the year, make, and model of your truck. And then you also have the other million expenses that we have, the tolls, the permitting, the factoring fees, the dispatch fees, the ELDs, the load boards, and the other gazillion fees that we have. Now, at a $1.93 round trip, most carriers are actually losing 10 cents to 30 cents per mile for every time they leave the yard. Now, this is not sustainable long term. Plain and simple. Now let's talk about what is killing our industry. We're gonna break down the main forces crushing small and mid-sized trucking companies. So number one, I think we all know this, that there's just way too many trucks and not enough freight. After the 2021-2022 boom, tens of thousands of new authorities flooded the market, everyone wanting a piece of the easy money. But that gold rush is long gone. Now in 2025, we have a severe supply and demand imbalance. There's too many trucks just chasing too few loads. Shippers know it and are driving rates into the ground. Bottom line, capacity oversupply means carriers are underbidding just to keep their wheels turning. Number two, the spot market has collapsed. Now this is where a lot of the small carriers, the owner-operators, and right now, it's a bloodbath. People are just undercutting each other's rates just to keep those wheels moving. Load boards are filled with bottom barrel rates. I mean, I've seen on load boards, 50 cents per mile, $1 per mile, 80 cents per mile, and people are actually taking those loads. Now you might be saying to yourself, just don't drive, just don't move. Well, those fees can add up when your wheels aren't moving. You're actually losing a lot more money. Now, brokers obviously are prioritizing their big fleet relationships because they know that further down the road, it's these big fleets that are gonna take their loads. Now, you guys need to understand, freight that used to pay $3 per mile is now moving for under $2 round trip. Many carriers are operating week to week with no predictability of what's happening and what's gonna happen ahead, and they're trying to nail contracts, but these contracts are coming out so low that sometimes it's not even worth to get into a contract with these low rates. Now, this is not a stable business model. Now, number three, you have the mega fleets and you have the cheaper labor. So large fleets are operating with dedicated lanes, the shipper contracts, and massive economies of scale. They can afford to haul for $1.60 and still make somewhat of a profit because they're paying their drivers 40, 45, 50, maybe even 55 cents per mile, or using foreign labor through their lease purchase programs. This race to the bottom is unsustainable for owner-operators and small fleets trying to pay their fair wages and cover their much higher costs than these mega carriers. Now, insurance is financially crippling right now. Insurance is one of the biggest fixed costs in trucking, but it's not so fixed. You don't know what kind of renewal you're going to get. If you're a new carrier, you're probably looking anywhere from $20,000 to $25,000 per year. Now, you have one bad claim or an inspection or just a really bad safer profile, well, your renewal is gonna get jumped about $5,000 to $10,000 literally overnight. In some cases, insurance companies are straight up refusing to renew small carriers unless they hire a safety manager or overhaul their operation. Now, the fifth thing right now that's destroying our industry is the diesel prices are still a killer, even though the rates have dropped a little bit. Fuel hasn't followed nearly as fast. In many regions, diesel is still hovering over $4 per gallon. For a truck getting 6.5 miles per gallon, that's around 62 cents per mile. That's not including the DEF, downtime, or rising maintenance costs due to poor fuel quality. Fuel is now eating 35 to 40% of gross revenues for many owner-operators. Number 6, lack of broker transparency. Now this issue hasn't gone away. Most of the industry still has no idea what the shipper is actually paying. A load may pay $3,500 from the shipper to the broker, and that broker might be paying you $2,000. The rest is hidden behind the broker margins and layers of non-disclosure agreements that they make you sign in order to work with their brokerage firm. Efforts to legislate transparency have stalled, and small carriers remain at the mercy of the broker relationships. And the result? We, the carriers, are doing all the work, taking all the risk, and getting the smallest slice of the pie. Now let's talk about cash flows, okay? So this is a big one. I'm sure you can all relate, whether you're an owner-operator or a small fleet and even a company driver. Expenses are paid up front in our industry. Revenues come later. Before a truck even hits the road, you're already bleeding cash, fuel, tolls, driver pay, repairs, factoring fees. I mean, this is all coming out of your pocket. These are all paid in real time, and most of the time you haven't even been paid for the load that you got. You're floating every mile on credit. The second thing is, if you thought that you can manage without a factoring company, that's going to be really difficult because brokers are taking longer and longer to pay. Now they're at net 30, some of them we see at net 45, and even at 60 days. And sometimes they ghost the carrier altogether. You've hauled the load, you paid for the expenses, and you're stuck waiting for weeks to get your money. This delay forces most small carriers to use factoring companies, losing 2 to 5% of their already thin margins just to survive. Number 3, receivables are slower than payables, so you're in constant negative cycle. Bills are due and payments come weeks later, and the gap in between, that's where companies get crushed. Most carriers are relying on credit cards, fuel advances, or loans and line of credits to cover the daily operations. Now let's talk about the bat that comes to the head, which is your annual plates, that one-time killer. The IRP plates and the IFTA fees are massive upfront costs. I mean, plates are anywhere between $2,000 to $3,000 per truck per year. Now, if you have a fleet of 10 or 8 or 15, well, you're looking about $30,000, $40,000 upfront that you need to pay, or else those trucks are not moving. And as always, and guess what? That eats away at your cash flow. Now, if you don't have that money set aside, you're stuck. Your trucks are parked and your revenues stop. Now, cash flows also get stranded on insurance renewals. They can definitely ruin you when your insurance renewal comes in. Sometimes you get a 25 or 35% increase literally overnight, and you need to come up with first and last. You know, depending on the size of your fleet, that's a heavy upfront cost. Even if your operation is solid, you can still get, if the insurance company had a bad year, your premiums can literally jump up 25 or 30%. And if you don't have the cash for it, well, just like that, you're out of the game. Now, trucking isn't dead, but it's definitely broken, and we're all paying for it. Now, $1.93 per mile is just not sustainable. And if we don't start calling out the bad actors, rejecting cheap freight, and demanding change, we'll keep running ourselves into the ground. Let me know what you think in your comments below. Are we still profitable? What's the break-even point right now out there that you guys see, and where are we headed to in 2025? Don't forget to like and subscribe and share with someone in the industry who needs to hear it. Until next time, drive safe, stay profitable, and keep fighting, because it will change eventually. I'm Ronen, and I'll catch you in my next one.